Hi guys, okay, in this video we're going to be having a look at moving averages and going through the different, um, basically how to trade using a moving average and the advantages and disadvantages and in what circumstances these moving averages should be used. So this is going to be the outline for what we're going to go through basically. So linear versus exponential, point moving averages, advantages, disadvantages, and then some specific examples here that I've used, and then we'll finish off by talking about the golden cross and the death cross. Okay, moving averages can be very tricky. You just have to know how to use them. So we're going to be going over all those points. So what I'm going to do is pull up basically a blank Bitcoin chart, and let's just start off with the basics. So the basics are that you either have a linear and a simple, or you have an exponential. Okay, the only difference between these two, linear and simple, mean the same thing. Let's just say you've got 5 moving averages, 2, 4, 6, 8 and 10. You take all of these, add them all up together, divide by 5. That gets you your linear or your simple moving average. They're the same thing. Exponential, all that means is it will put more weighting towards the more recent price action, and thus the moving average would probably be a little bit higher in this case. Obviously, if this was trending down, it would probably be a little bit lower. On balance and purely as just a, you know, the way I like to do things, I prefer exponential only because recency is very important to me. Okay, obviously there are specific examples which I'll get into in a minute where I use linear and simple, but if I had to choose between the two, I would rather exponential only because recency is very important. What happened a week ago in the stock market is more important to me than what happened a month ago, and what happened a month ago is more important than what happened a year ago. So recency is very important, and so I tend to put a little bit more weighting towards exponential than I do linear. Okay, but essentially that's the difference between the two. Obviously, in this particular example, this moving average might be moving like this, whereas this would have a slightly increased gradient only because there's more recency here. There's more higher numbers recently, so it's probably going to give you a quote-unquote signal a little bit sooner. Now, these moving averages are dynamic. They're constantly changing and they're constantly evolving. Technically, they are all point moving averages. So if I just pull up indicators here, let's just pull up, I don't know, any moving average. Let's just talk about the 20. So this is now on the daily time frame. So this is the 20-point simple or linear moving average for the daily time frame. The minute I change that, as you can see, it's on the Bitcoin chart here. So let's just make that a little bit larger so everyone can see it. Let's make that in blue. Okay, good, perfect. The minute I change the time frame, this then becomes the 20-point moving average for the hourly time frame, i.e. the moving average linear for the last 20 hours. Okay, and if I put that on the 5-minute, it will be the 20-point moving average on the 5-minute time frame, i.e. the moving average for the last 25-minute candles, i.e. 20 times 5 makes 100, so the last 100 minutes, and here it would be 20 minutes. So you've got to understand the reason the line moves on different time frames, because technically it's a point moving average. Obviously that's a very obvious point, but it's important just to highlight that. Now, before I go into the advantages and disadvantages, I want to give you a few examples of the major ones that we use. So the major 4 that we are interested in terms of linear or simple, are basically the I'll just pull them all up here. Right, so it's basically, it's the 20, it's the 50, it's the 100, and it's the 200. Okay, these are basically the 4 most important moving averages. Okay, obviously, as you can see here, the larger blue line is the 20, that's the 50, that's the 100, and that's the 200. And what you have here is a phenomenon that we call stacking. Okay, it's very obvious what that means. All that means is the 20 simple is above the 50 is above the 100, and the 100 is above the 200. Okay, obviously that stacking started to roll over around about 9,000. Okay, but that is a confirmation of a very strong trend whenever you see stacking going on. 20, 50, 100, 200, all on top of each other. That's on the daily, but I wouldn't be surprised if we got that also on the 4 hourly. Yeah, when Bitcoin was about 6, 7,000, we kind of got that here, and that would have probably got you a little bit higher than the daily. Okay, but that's the phenomenon used as stacking. Now, out of these three, I would say the least useful in my experience is the 100-day moving average, or the 100-point moving average. I very, very rarely, if ever, use the 100. So if you were to pick three of them, these are the major ones that you want to be interested in. Now, let's just look at what a golden cross is. Okay, so all the golden cross means is basically is when the 50-day moving average, so it's on the daily time frame. That's the first thing. Technically, you can have a golden cross or a death cross on any time frame, but generally we're looking at the daily time frame. Okay, basically it means when the 50 rolls underneath the 200 and the 50 rolls above the 200 on the upside, that would be a golden cross. So as you can see, we've had death cross last Easter, and we've had a golden cross now. Now that doesn't mean we're in a new bull market. Okay, it doesn't mean we're going to go to 40,000 on Bitcoin. All that means is it's a very strong confirmation of trend. One of the many reasons that I'm saying it's going to go to at least 6k. You're not going to see 3.1k for months, as I've been saying. Okay, this is you can get a golden cross within an otherwise contracted bear market. Okay, but that's what a golden cross is. Now let's just show that on the 4 hourly time frame. As you can see, we've had golden crosses and death crosses all over the place. Obviously, the shorter the time frame, the more of these crosses we're going to have. Technically that was a golden cross, technically that was a death cross. So if you were just to trade on these two signals, you would have got in here, got out here, gone short here, probably would have got stopped out on there, let's be honest, and then probably would have closed here. Now, so those are your major moving averages. Okay, now let me just show you something with the 20 moving average. So we've covered the major four. Out of all of them, probably you can drop the 100. It's probably not that important. Now let me just go on the weekly chart actually, because this is very relevant to what's happening right now. So right now, once again, this is the 20 and the 50 point moving average for the weekly chart. Right now we're kind of finding some resistance at the 50-week moving average, and we bounced off the 200-week moving average. What you see here is basically price acceptance below a key level. Okay, we're kind of going to go off on a tangent. Whenever you get price going into horizontal level, trend line, Fibonacci line, moving average, and price just chills there, it just chills there and doesn't go down, that is a signal to close your position if you're short. Okay, eventually that price is going to break, because what this is showing to me, price is getting accepted below a key level. Okay, whenever price does that, often you won't get this. You're not going to get this. Often this is the calm before the storm, before we break that moving average. Okay, so the worst thing to be in Bitcoin right now is aggressively short to the downside. Okay, participants in the market are coming together and they're accepting a price below a key moving average, and that means that moving average eventually is going to break. Might not happen this week, might happen next week or the week after, but this is a very clear signal to me this market wants to go higher. Okay, if you get price coming into a key level, and usually it would just do this, or it might hit it, bounce off, hit it, bounce off, and then break, retest, and then go back up again. But whenever you get price consolidating below any key level, once again, that could be Fibonacci level, monthly pivot level, it could be a moving average, as I've just mentioned, it can be a horizontal level. Whenever you get price just chilling out below a key level, that is a clear sign by the market telling you get out of that short position. If you are looking to short there, this is definitely going to go higher. Now, that's just something to note. Now, that's the 50, that's the 200. Now, let me show you something about the 20-day moving average. Those who use Bollinger Bands, for those who don't know, Bollinger Band basically takes into account the standard deviation of moves. The middle line in a Bollinger Band, as you can see, is actually the 20 linear moving average. So the 20 linear moving average is a very good short-term indicator. Okay, the reason 20, 50, 200 work really well, because 20 is over a month, 50 is over, let's say, 2.5 months, and the 200 is more of a long-term moving average. Obviously, hedge funds, they trade on momentum. They have a lot larger capital. They will often use the 50 and the 200 to enter positions. Okay, above a 50, they will go in. Whenever the 50 is above a 200, they will often trade to the long side. But they're holding more long-term positions. Okay, it doesn't always work for a retail trader. Now let's just go on to the Bollinger Bands. So Bollinger Bands I cover on my Shopify store. I won't go into it here. But basically, even the Bollinger Bands are now telling you a big move is coming and it's going to be to the upside. I mean, even just by looking at this. But the middle line in a Bollinger Band is the 20 simple moving average. Let me just make sure I'm recording this. Yeah, so as you can see, this completely overlaps the 20 moving average. If I take off the moving average, as you can see, that's the 20. Now, let me take off the Bollinger Bands. The 20 simple moving average is very useful on the ES, or pretty much on any futures or Forex contract. Now, let me show you how to use it. Now, once again, this is the 20 daily, okay? Shows very, very good uptrend. But the way I use it from a day trading perspective is on the 15-minute chart, okay? Some of these moving averages, you're gonna find that they're much more useful on certain time frames. And I found with the ES, when you're day trading the ES, the 20 simple linear moving average on the 15-minute time frame is a very good confirmation of trend. So as you can see here, just an arbitrary example here, it broke the 20 here. The price was, I don't know, what was that? 2924.75. It stayed above the 20 moving average on the 15-minute time frame and didn't really break it until 2943. So that would have got you, if you had used this moving average, that would have got you 18 and a half handles there. Let me show you another example. Okay, here breaks through the 20 moving average on the 15-minute time frame, retests that support, continues to go higher, doesn't really break until here. That would have got you 27 handles, and it's $50 a handle, so you can do the maths. That's just for one contract. Obviously it works to the downside as well. That's with the ES. I'm pretty sure that would work on oil as well. If you were to bring up the oil contract, it would probably work here as well. Okay, as you can see, 20 simple moving average, 15-minute time frame. It comes here, breaks it, comes back down again, and that would have got you well, you would have bought in on this breakout. The minute it breaks through, you put your stop below the low. As it starts to move away, you bring your stop to break even. Didn't really break it until here, and that would have got you 191 pips. I'm not sure what the futures contract per pip is on oil, but it's got to be at least $10, I reckon. So that's the way I use the 15-minute 20 simple moving average from a day trading perspective. Now, another moving average that I like to use, so those are your simples basically, 20, 50, 200. The 100 I don't really use. Now, I like to use exponentials every now and then because recency is very important to me, as I've just mentioned. So the exponential moving average that I always have on my chart, there's a few of them, but let's just go over the 50. The 50 exponential moving average is probably my most favorite moving average, and I mention this all the time. I mentioned it again on my webinar with Cenex FX on Saturday. I don't use this on the 15-minute nor on the daily. I use it on the 1 hourly time frame. Okay, once again, the 20 simple moving average you use on the 15-minute time frame on your day trading futures contracts. But if you want more of a swing trade, let's say you're getting into a stock and you want to ride that stock up for, let's say, 3 to 10 days, I found the 50 exponential moving average on the 1 hourly time frame is very, very useful. Okay, so obviously this is not a stock right now, so let's just find a stock. But even here you can see it broke through here, started to sort of flatline, volume falls over, and you could have held that all the way up to here. So with the ES, the way I do it, I have one swing trading account and one day trading account. But as you can see, that would have got you 82 handles within 10 days, if that's the way that you want to do it. Now, on gold, it often works well. So as you can see here, it breaks down below the 50 exponential moving average, and it didn't really cross back again until here. Once again, these are just off the cuff examples there. I've not really planned any of this. Let me just get this off, not sure what's happened there. Okay, 50 EMA breaks down here. That would have got you I would have got you basically $30 move on gold within 7 days. Okay, so this moving average is very useful for those who don't have the time to look at your screen every single day, but you do have the time to look maybe every 3 to 10 days. Once again, another example, oil, gold broke through here, 50 EMA, 1 hourly time frame, didn't really break down above that line properly on high volume until it went to here, and that would have got you $43 move within 10 days. Okay, so this is the thing with moving averages. The way that I use them, I use certain moving averages at certain times, but it's very specific to what I'm doing. You can't just use one moving average. You have to know which ones are useful. As you see here, break up in gold again, above here, retests it. So once it starts to move, first you start off your stop below the key swing low. Then as it starts to move up, you bring your stop to break even, so you can't lose anything on that trade, and then it starts to move. Obviously, moving to break even too early may get you stopped out, so you need confirmation the price is moving away from you first. But as you can see, stayed above that moving average until here. That would have got you $35 move within 7 days. Okay, and I can go into these many examples here. Now let's just pull up oil. Yeah, works fairly well on oil as well if you're gonna swing trade. So nothing wrong with having a swing trading account and a day trading account. Now let me see something that was moving quite violently in January. So this is just off the cuff. Now let's just see. This was moving quite violently, as I recall. Yeah, I mean, it moved so violently here. I'm not sure if we're going to get a good signal here on Netflix. Yeah, that probably would have got you in here. So it would have got you in at 254, broke above here, and you would have stayed in Netflix until it broke the moving average here. So that's $84 move, which is basically 33% within 21 days. Okay, so that's just the way to play this game. You have to know which moving averages are useful for which strategy. And like I said, for a day trading strategy, I find the 15-minute 20 simple is very useful. For a swing trading, 50 EMA on the 1 hourly time frame. Okay, now the last thing I want to cover is the 8 EMA on the weekly. Okay, now the last moving average that I like to use is the 8 exponential. This is more for stocks that I'm going to hold for, let's say, longer than 6 weeks, six weeks or longer. And basically this is just trade or trend confirmation that I'm still going with the trend, because that's basically the way you make money in this game. And that is to pull up on the weekly moving average, and here you want to use the 8 exponential, but on the weekly. It doesn't work on any other time frame. Maybe on the daily you can stay with the trend, but generally I'm using it on the weekly moving average. As you can see, Netflix has never really gone below this moving average, which shows the trend is still intact. As you can see here, you would have gotten at 192, you would have held that all the way up to here, so that would have been a 200% move basically within 200 days. Okay, so if you're more of a longer term investor, the 8 EMA on the weekly time frame is very, very useful. As you can see here, it trended all the way down, didn't really break it. Okay, and the 8 EMA on the weekly, I mean, what is that? That's how many days is that? It's 8 EMA, so 8 weeks. What's that? 56 days, I suppose. Yeah, yeah. So it works as like a 50-day moving average, but it probably works a little bit better, I found. Now, this could probably also work with strong trends. Let's take up oil again. Wouldn't be surprised if it works with this because it's been trending really well. Yeah, so it trended all the way down, broke the 8 EMA on the weekly, went all the way down, broke up, and it never really closed below the 8 EMA. So oil technically is still in a nice little uptrend. Obviously, we've moved pretty much 50% in about 2.5 months. We're bound to get some kind of pullback, but this is very useful for people who want to hold more longer term positions, and I find this very, very useful. I'm trying to find another stock that's been trending well. GE was trending well up until the last little move here, so that kind of worked really well here. So broke down 8 EMA, broke above 1, 2, 3, 4, 5, 6, 7, 8 weeks, stayed above the 8 EMA. Obviously, the problem with moving averages is that it can be quite lagging, but that's just another moving average that I use. Okay, so those are the ones that I use, basically 20, 50, 250, and the 8 EMA. But I only bring these up on certain occasions, and I'm very, very clear when I use them. So the 20 simple is on the 15-minute time frame for day trading. The 8 EMA on the weekly is for knowing that I'm still in a trend on a long-term position, i.e. 6 weeks or longer. And the 50 EMA is more of a swing trade, maybe 3 to 10 to 14 days. Okay. And I think that's everything I wanted to cover. I've covered golden cross, death cross, advantages, disadvantages. I've covered the Bitcoin price and the way it's sort of behaving, and the fact that any key or any consolidation like this below a key level means it's probably going to break. Let's be honest. So that's probably going to break. And as you can see, on the 50 EMA, I think it's pretty much broken that already. But people use the 50 SMA, which is fine. So the advantages and disadvantages. I don't think it's always a good thing to rely on moving average. As far as I'm concerned, Fibonacci, Elliott, and volume, if you've got a good grasp of all of those things, you could probably do really well analyzing the markets. As you guys know, I made a call that Bitcoin would go to 20,000 when it was at 14,000, and then it's going to go to 2,000. There's no way anyone can make that call without analysis of Elliott wave and fibs. That pretty much would have got you out near the top. Wyckoff distribution here would have got you out within 5% from the highs. But the way this moving average then curled over, many people, if they were using this, would have got out at 7,000. So you've missed out on $13,000 there. So there is a bit of a lag. It's not always a good idea to rely too much on moving average, but I do agree long-term money moves the markets, so it's very good to know the overall trend. I will only use a moving average only in certain circumstances, as I've already established during the course of this video. But as far as I'm concerned, moving average is secondary to Fibonacci, Elliott wave, volume. If you understand volume and candlesticks, Elliott wave and fibs, you're already better than 99% of people out there, as far as I'm concerned. Obviously, then you can draw a few key support levels like here, whatever here, and then that's pretty much all you need, really. You don't really need to make things too complicated as far as I'm concerned. Let me just do one more thing. I was going to do this the other day on my other Bitcoin video because I want to just get this pitchfork. And even with pitchforks, I would only use them on certain occasions, but I'm sure it hit the median line. Yeah, so it's not actually gone to the median line here. So from my knowledge of pitchforks, once again, I don't use pitchforks often, but if it bounces off here, it should hit this median line, which it hasn't done. So this is just another reason why Bitcoin at some point will probably hit this median line somewhere up here. I don't know when it's going to do it, but that's just another reason why Bitcoin should go up, because there's an 80% chance of that happening supposedly with pitchforks. Anyway, yeah, so that's the advantages, disadvantages. Anyway, I'm going to wrap it up there because I'm just rambling on now. But hopefully you guys found that useful. These are the points that we've kind of covered here. So these were the points. So linear, exponential, point moving averages, the good points, the bad points, and try to experiment with everything that I've said here. 50 EMA on the 1 hourly, 20 SMA on the 15 for ES or for any day trading futures, maybe even on the SPY, and the 8 EMA for more long-term sort of investors, and that would be useful. Anyway, I'll wrap it up there. Hopefully you found that useful, and I'll catch you guys on the next video.